Bonjour, bienvenue à ce webinaire de la chaire sur la décarbonisation. Mon nom est Marc Purdon, professeur à l'UQAM et titulaire de la chaire sur la décarbonisation. Je vais switcher en anglais. Welcome to this webinar of the chair in decarbonization. We're presenting the results of the February 2023 joint auction of the California-Quebec carbon market. So as we allow people to come in, I'll perhaps move to our first slide. Today we actually are doing something a bit special. We will have an overview of the auction results from the California-Quebec carbon market under the Western Climate Initiative, including prices obtained in the February auction, as well as portion of emission allowances, and discuss a bit the trends. And it's great to have Colin's perspective on this from California. But late last December, the Quebec government also published a report on the emissions trading with California over the 2013-2020 period. So we're gonna talk about that briefly, look at those results a bit. And then as an added bonus, the state of Washington has also recently established what they call cap and invest. It's essentially a cap trade market that's not linked with the California-Quebec carbon market, but it operates also under some of the rules of the WCI. And they published their first auction results just yesterday. So we're going to look a bit at those in the context of what has been transpiring in California-Quebec, and I'm sure Colin can give us a bit of perspective on the state of play in Washington as well. So I don't know, Colin, if you had anything to add to this introductory slide, but
yeah, I think that's a great introduction. I'm happy to provide some insight, but I don't want to launch into anything substantive until we've gone through the presentation.
Excellent. Okay, so let's get started. I think we're well into it. So just some background on the carbon market allocations between Quebec and California. There are 4 auctions a year. What's important is a auction price floor, which started at $10 US in 2013. It's been increasing 5% each year. And the price floor is intended to help reduce some of the problems associated with overallocation, which could result in a reduction in carbon prices. There's also a carbon price ceiling. It was initially established as allowance price containment reserve, but this was reformed in California for the 2021-2030 period, which put in a firmer price starting at $65 in 2020 and also increasing 5% each year. There's also a bit of a discussion about free allocations. Initially, over the very initial period in Quebec, and I think it's comparable in California from 2013-2014, the amount of free allocations was relatively high at 80% free in Quebec. But over 2015-2020, the proportion of allowances has reduced as other emitters were brought under the cap. I know in Quebec where there are now discussions about developing new regulations to reduce free allocations for the period 2024-2030. And I think California is perhaps a bit more ahead of us on that issue.
So in California, the free allocations to many of the industries that are in what's called the Industrial Assistance Program were fixed as part of the compromise needed to extend cap and trade beyond 2020. So it created this sort of 3-category system, and anybody in the medium or high risk categories get free allocations through 2030. So there's not as much flexibility to reform that in California without going back and getting a new bill from the legislature and potentially sort of reopening that compromise.
Terrific. Okay, so let's get to the results. So perhaps the The most important thing here are the settlement prices. So you have the price floor, and we have these in US and Canadian dollars. But the price floor for current vintage and future vintage was the same, $22.21 US, $29.64 Canadian. And I think the trend we're seeing is that settlement prices, so the actual prices obtained on the auction, were above the price floor. So $27.85 in the US and $37.17 in Canada, Canadian dollars for the current vintage. And a slightly depressed settlement prices for future vintages at $27.01 in the US dollars, and $36.04 in Canadian dollars. Any immediate reactions there, Colin, or I could go to the kind of historical kind of tendencies?
No, this is it sort of follows the trend of the price gradually escalating off the floor after many years, which is from a climate policy standpoint quite welcome.
So this is the historical trends, and as Colin was saying, we have the sort of since mid 2021, you've had sort of a departure of the settlement prices from the carbon price floor, and I think these are both in Canadian dollars. But we have vintage prices in early 2021, perhaps related to the war in Ukraine. I'm sure there's many explanations, theories for that. But I think the interesting thing is sort of the gradually uptick in the carbon price since 2022 on current, and a little less pronounced in that way on the future vintages. And Colin, if you have any insights here.
No, I mean, from the California perspective, the last 2 years has really been dominated, really in climate policy, dominated by the preparation and debate around the scoping plan, which is California's master climate policy strategy document. It's updated every 5 years. So they just adopted a new scoping plan at the end of 2022. And really, all of the markets linked to California climate policy were kind of in a holding pattern until they saw what happened after the scoping plan. Now that that's done, several of these key policies, including the low carbon fuel standard this year and then the cap and trade system next year, are going to go through rulemakings to bring them in line with the strategic targets set out in the scoping plan. So I think to some extent markets were expecting that CARB would increase the stringency of the targets, so reduce the allocations, reduce the cap in the cap and trade program. But nobody was really going to sort of jump into the market with both feet until they got further into the rulemaking and had a little more clarity on what precisely the plan was. And to me, these results align with that interpretation.
Terrific. So I'm going to move ahead to the proportion of allowances purchased. So 87% of the allowances that were on sale for the current vintage were sold, 78.8% of the future vintages sold. And I can again show you this in a historical perspective. Seems to be a bit of a decline in the number of allowances, proportion of allowances sold current vintage, but I guess, around 80-90% in the current vintage, whereas trending towards 80% in the future vintages. So I guess there seems to be a bit of a downward trend here, but maybe not that significant. But I don't know, Colin, if you have any insight there.
Again, I think nobody's making long-term plans until after CARB at least gets well into the rulemaking on the cap and trade, and there's a lot more clarity on what the long-term trends and market outlook is going to be. I suspect that once the rulemaking starts moving forward and CARB releases their first draft proposal, you're going to see the market players who are tracking that process, the large and smart ones they will start adjusting their strategy and my expectation again would be CARB is going to indicate a reduction in the total allocation of allowances, indicating the market price is going to go up in the long run, and people are going to start buying more of the future allowances before those price increases really hit.
Great. Okay, well, that's about the sort of the update on the carbon market, the carbon auction results from February. And we can come back to that in a question period. But we thought also now just to kind of look at how the carbon market exchanges have developed over the first linkage period of 2013-2020. And again, there's been some, this is made possible by some new results. We want to give you some perspective on this. This is just sort of a slide showing emission reduction targets, California, Quebec, as well as Canada-wide. And there's some links below if you want to get see where these numbers are coming from. But maybe the main point here is we're only talking about the linkage between California and Quebec, but California's emissions, at least in 2005, were comparable to those of Canada as a whole, much larger than Quebec's, 482 million tons CO2 equivalent, whereas about 86 in Quebec. But where things started to change, and it's important to bear this in mind when we're looking at results for 2013-2020, is that the targets were quite different. California was seeking to reduce emissions to 1990 levels, whereas Quebec has been more ambitious during this first period, seeking to reduce its emissions 20% below 1990 levels. And we put on the slide there, you can look at what Canada is doing. Canada ostensibly withdrew from the Kyoto Protocol, which had a comparable target of -6% below 1990 levels. Moving forward in 2030, in 2040, 45, and 50, we see things are starting to, California is a bit more ambitious than Quebec, with a 40% below emission reduction target versus a 37.5 emission reduction target in Quebec. In Canada, Canada calibrates its emission reduction target under the Paris Accord relative to 2005 levels, but we can estimate what those would be in terms of 1990 levels. So that's a 26 to 32% reduction relative to 1990 levels. California's going for 85% reduction below 1990 levels by 2045. Quebec is still developing a target for 2050, though it does state on its website the government intends to make a commitment to achieve carbon neutrality by 2050. And Canada has, however, committed to a net emissions target by 2050.
I would also say California has also committed to carbon neutrality by 2045. That 85% target is for in-state emissions that are on our GHG inventory, and it's basically meant to put a cap on how much of the carbon neutrality commitment can be met through offsets or carbon dioxide removal projects. It's meant to ensure that the majority of our achievement of carbon neutrality is through emissions reductions rather than, CCS or some other mechanism.
Right. Before I move to the next slide, I think just to highlight again, it's just for when we're looking at the results from 2013-2020 emission trading, a rather ambitious target of -20% in Quebec, whereas California is seeking to reduce its emissions to 1990 levels. So to give also some more context, what this looks like in terms of emission reductions, you see in 2013-2014, this is a bit, I think California's carbon market started in 2012, and then there's the Quebec was added to that maybe in linked with that in 2014. But we're combining the caps from the two jurisdictions in this slide. And you see this initial period, 2013-2014, where only large emitters in the two jurisdictions were being regulated under the carbon market. Whereas in 2015, you also added to this the distributors of liquid fuels, oil, gasoline, natural gas, etc. So that really increased the scope of the caps, and you see some of the emission reductions, how they're intended to ramp down by 2020. So just a combined target of about just under 400 megatons. I'll just go to the next slide. So this is for some of our Anglophone participants on this webinar. You may find this report interesting, but it's only published in French. It's the final results of the California-Quebec market exchanges. And I think the take-home message is, and here they have the emissions in 1990 at 85.3, and Quebec was able to reduce its emissions on Quebec territory by 13%. And with the additional trading, it reduces doubles that reduction, I guess you could say, to minus 27% with trading. So this is an interesting result in the sense that we have just a 11.2% reduction between emissions levels between 2020 and 1990 on Quebec territories, but then you add another 11.4 of emission reductions, or the purchase of emission allowances from California. And there's another slide here where we can break this down to a bit more detail, and then we'll get some commentary from Colin as well. So this is just showing the annual breakdowns on the first group of columns, Quebec territorial emissions. We see a decline from 85.3 megatons in 1990 to 74.4 megatons in 2020, which is a reduction of 11.2 megatons, which is difference between the 1990 and 2020 emissions. But then the middle column has the Quebec trades. And what's interesting is that in 2013, 2014, there was actually inflows into Quebec. And so you had California firms purchasing 1.1 megatons of emission allowances from Quebec firms, and then that goes up to 2 megatons in 2014. But when that carbon market expands, the coverage expands in 2015, this is when we're seeing the flow of emission reduction purchases reversing, and we see that Quebec firms are buying 5 megatons, total to 5 megatons from California in 2015, and this goes up to 11.4 megatons in 2020. So this is, I think, an interesting result. This, I think, corresponds with what the economic modeling was suggesting would transpire on the Quebec-California carbon market, which we've discussed in perhaps some other of our webinars, but that Quebec has been a net purchaser of emission allowances from California. And that has resulted, if you include the emission allowances from California, the Quebec reductions have declined to 62.6 megatons, and representing a difference relative to 1990 levels of 26.6. Colin, I'm sure you may have an interesting perspective on what this represents, and if California even has noticed it.
Definitely noticed. So one of the main dynamics that was really prominent in certainly discussions around the California cap and trade market through the late teens and early 2020s was the structural oversupply of allowances relative to anticipated demand. And so clearly there was an oversupply. It's a big part of the reason why the market has been riding the price floor for most of its history. And really, the Quebec has been incredibly helpful in not letting that problem get worse. And the fact that Quebec was anticipated to be a significant long-term purchaser of California allowances for their own compliance. You know, on one hand, it definitely, I think, helped avoid the floor even without having the you know, structural reform or target adjustment. You know, you could look at it on the other way and say that if Quebec hadn't been there, maybe there would have been greater incentive for the reform to happen, you know, the way it should have, and have California tighten the targets. You know, the counterfactual, I don't know. But it was definitely noticed, and you know, I think the market is in better shape today because Quebec was able to absorb some of that structural oversupply.
Mm-hmm. There's some of a debate in Quebec that these allowances don't necessarily represent genuine emission reductions because of some of the issues around oversupply and resource shuffling, sort of carbon leakage.
Yeah, I mean, those are completely valid concerns. Whenever you have a carbon market, there's really no way to perfectly protect against leakage. There's always going to be some. And there's also always going to be some reductions that are, you know, on paper, but really not particularly additional. You know, energy efficiency improvements that probably would have happened in the status quo, things like that. There are certain mechanisms that you can do to minimize the impact, and I think, you know, CARB has adopted some of them and could certainly do a better job adopting more of them. But I think to some extent they are kind of the price of doing business, that you're going to have some of the impact of the market absorbed by either leakage or you know, non-additional mechanisms. But at the end of the day, we are seeing California's economy on aggregate reduce their greenhouse gas emissions. Now, it's not entirely due to cap and trade. There's a full portfolio of kind of policies, and cap and trade both the carbon marketplace, cap and trade, and the LCFS function in a very critical but complementary role in that way. And ultimately, you know, we are on a trajectory where achieving both our 40% countywide GHG target by 2030, as well as carbon neutrality by 2045, are plausible. You know, there is a pathway that doesn't require anything that we think would be tremendously damaging to the economy or incredibly disruptive. So, on the whole, I think California's policy has a success, and the cap and trade has, well, certainly could have done more, and I think Parks should have adjusted the target several years ago when the oversupply was becoming apparent. It's been robust enough to still provide a lot of benefit and contribute to a successful policy portfolio.
I'll turn to this graph because it kind of addresses some of these issues. So how have the emission reductions between the two played out? This is these graphs are based on the individual inventories of California and Quebec, in which we just combined to produce these graphs. The black first larger graph is California-Quebec, the combined model, and what we see is California's emissions. And it's a bit obscured with the COVID crisis leading to, I think, a very significant reduction of emissions in California, a little less so in Quebec. But we may have actually showed these graphs before. What's new is in this version, we've added those emission allowance trades from the report we just showcased into the graphs in the California only and the Quebec only graphs. And the dotted lines are the emissions adjusted for exchanges, and the solid lines are the territorial emission trends. So we see in the red, you see a slight increase in California's emissions, a slight bulb of that kind of elephant trunk. Whereas in Quebec, we see that emissions were actually, you know, climbing up a little bit between 2016 and 2018, but emission reduction purchases of allowances from California have brought that below the Quebec target, which is the green line there. And so, but California was well beyond its emission reduction target in 1990. know if there's any kind of comments you want to make there, Colin.
I mean, I think so totally agree that we achieved the 2020 goal several years early. Main reasons for that being the 10 through 12 recession kind of started us at the start period at a lower emissions level than we thought, and it gave it a kickstart. And then the other big impact was how quickly wind and solar came down in cost and enabled significant decarbonization in the electricity sector. From an emission standpoint, these are both good, but I think it really highlights the challenges of operating and administering a carbon market like this, where things that are really not foreseeable are going to have major impacts on the functionality of the market. And so mechanisms to automatically adjust credit supply, I think we're realizing take on a larger role in order to maintain a functional market, because going through a rulemaking to have the regulator manually adjust this, it opens up to political interference, and also there's a lot of bandwidth restrictions. One of the things that I was going to mention elsewhere, but I can sort of talk about here. One of the reasons why it's taken so long for California to get to a rulemaking and adjust both this program and the LCFS, which is also sort of experiencing a very low credit price and is at a bit of market crisis right now, is because to effectively adjust these programs requires a lot of modeling capacity. You have to go and do fairly complex integrated economic and energy models that will project performance out for a decade or more, in some cases out through 2050, and run a very wide variety of scenarios to understand the full range of implications. And even though CARB is an exceptionally well-funded and well-resourced environmental regulator, their modeling team is, a few 5-10 people or so. And they have made the I think, appropriate decision to say we're going to have sort of one central modeling team that will move from rule to rule to support rulemakings, because they need to make sure that changes in one rule interact synergistically, or at least compatibly, with all the other climate policies that are happening. The downside of that means there's a bandwidth restriction. They can really only sort of do rulemakings to make adjustments in market-based programs when the modeling team is available to do all of the sort of background work required to fully understand Future Act and others to do these kinds of models to understand the economic and social impacts. So what this means is for the last year and a half, all those modelers have been focused on scoping, where they're modeling out the entire economy over the next 25 years to set that strategic target. And there hasn't been capacity to do the focused modeling needed to update the LCFS to try to address the credit price collapse, or update the cap and trade targets to do that. In theory, it should be relatively simple for CARB to make relatively small administrative adjustments to targets in order to keep these markets on track, but they have decided that they need to do the full modeling and dot every I and cross every T to do that. So those bandwidth restrictions have to be considered when you think about the rulemakings, the changes in the policies that are going to come down over the next several years. So with the modelers having completed the scoping plan, they're now moving on to the LCFS. That rulemaking is going to commence this summer. It's going to be a lot more limited than we thought. They're probably going to do another rulemaking a year or two to deal with more complex issues. But that modeling team is basically committed to LCFS through the rest of the year, and next year is when they'll really get into a cap and trade update.
I wonder, I think the Quebec government should be looking at modifying some of the rules around the cap and trade system later this year. I wonder if one of the solutions for some of the concerns about oversupply can be found in the European experience. I think the EU ETS is widely acknowledged to have been vastly oversupplied sort of from the get-go. And it took them until 2018, I believe, to introduce a market stability reserve or mechanism to sort of vacuum up some of the loose allowances. I wonder if something like that are you hearing some discussions around that type of mechanism in California, or something much more completely abandoning the carbon market after 2030?
I don't think there's any risk that the carbon market is being completely abandoned after 2030. The investments that have been supported by the Greenhouse Gas Reduction Fund, which is our vehicle for dispersing auction revenue, have been very popular and very successful. So I can't see it. Now, I must confess, most of my time over the last year has been focused on the LCFS. I'm not quite as connected to the political and stakeholder discussions around cap and trade readoption as I was with the last round a few years ago. But nothing I've heard indicates that they are thinking about abandoning the cap and trade market. One of the interesting dynamics I have noticed at CARB is there has been a tremendous turnover in leadership over the last 2 years. We have a new board chair, we have a new executive officer, most of the board members have turned over, and many of the key senior modelers, program directors, branch managers, et cetera, in a lot of the programs have turned over. So it really is a new generation of people in charge. And one of and so there's two impacts that I think are relative to the market. One is that the new leadership seems a lot more willing to be ambitious where climate policy has been concerned. If you go back to the discussions around cap and trade that happened in the late teens and early 20s when we first started becoming aware of the structural oversupply, the leadership at CARB is, and this goes up into the governor's office, was incredibly averse to anything that could increase, energy prices or consumer prices in general, and they were just, bending over backwards to make sure that they couldn't be accused of increasing, particularly gas prices. And this is in part because when California passed the last gas tax increase, the oil industry was able to get a Democratic senator recalled over it. So they were able to flex their sort of political muscle. And I think this scared a lot of the political leadership. And they got just gun shy about anything related to the price increase. I have not seen that behavior out of this new crop of leadership. If you even look at some of the slides and discussion that they put out around the LCFS and some of the pre-rulemaking workshops over the last several months, it is, just shocking to me as someone who's been connected to California climate policy for over a decade to see how willing they were to put out material that admitted that, there is going to be some price impact policies. And there is. You can't run a climate policy that has zero price impact, right? It's going to take some increased costs in the near term to get these technologies mature to where you eventually in the long run gain price benefits. But never in the past would they have sort of admitted that or put out public data that would really support that argument. So I think it's likely that the conclusions are, and it's really likely that in this rulemaking on the cap and trade that's going to happen next year, there is the opportunity to be significantly more ambitious on the cap and trade than I think there is significantly more appetite to tolerate cap and trade prices that diverge significantly from the price floor. I don't know exactly what that means. I don't know, if there's a targeted price or a band of comfort in the CARB leadership. I'm not that sort of deeply connected with them, but I do think a significant strengthening, strengthen the target, so reduction in future allocations is quite likely in this upcoming rulemaking, and I'm in ways that I just could not have anticipated in the last generation of leadership. The other thing, and this is kind of the downside of having a lot of new people, is these programs are complex. All these programs have a lot of history, and political dynamics that help explain how they came to be the way they are. And I think there are a number of folks that don't sort of have that historical sense and don't have the long-term context, and don't quite grasp the complexity of regulation and carbon markets like this, and are perhaps coming in somewhat naive to the idea of, just drop the target by X amount and that solves the problem. I think one of the things that I say quite a bit is when you talk about climate policy, if you can tell if somebody's either lying or poorly informed if the words "it's simple" ever come out of their mouth. I do kind of wonder if some of the stakeholders around this policy, because the turnover is not just in CARB, it's also in a lot of the stakeholder community. I do think that there are a number of people who might think this is simple, or that the solution to this problem is simple, and it's not. So a little concerned that there's going to be a bit of a learning curve and some mistakes coming out there. But I think with a lot of engagement from the community, particularly from those who have been around this and part of it for years and have historical perspective, I think they are willing to talk and willing to accept guidance. And I think that guidance exists. It requires stakeholders on the outside to be really proactive to try to engage.
Mm-hmm. Well, maybe we can revisit these issues in the discussion, and they're in the Q&A. Sure. Right now, I just want to turn to something completely different. And these are the Washington State February auction results. And again, these were just released yesterday, so I guess our timing was good. But they're actually quite interesting, and there are a number of caveats here. Maybe before we get to the results, and Colin, correct me if I'm wrong, but it's a cap and invest program managed by the state of Washington. It's using some of the resources for auctioning and maybe some of the IT resources offered by the Western Climate Initiative, but it's really an independent initiative that is not linked. It's a cap and trade system, but it's not linked to any other cap. It's not linked to
stakeholders in Washington, and several of them in kind of the Department of Ecology, which is the main regulator that manages this, that would like to eventually join and have a joint market with California and Quebec, and they recognize the value and the flexibility that a joint market offers. If you look at Washington's climate policy, there is a bit more, sort of in-state focused. In their low carbon fuel standard, for example, there are provisions requiring a certain amount of compliant fuels to be manufactured or produced within Washington State. So I think they recognize that WCI is a very strong and functional model, and I think they're hoping that eventually they will link. But right now, there's just enough people who want to make this a Washington-only program that the political will is not there.
Mm-hmm. Well, let's maybe look at the results. So essentially, they only had the auctions for the current vintage, and no future vintages were on sale. But I think there's some pretty striking results. The price floor is essentially the same, and they only publish the results in US dollars. I made the conversions today into Canadian dollars, but the price floor is essentially the same as on the California-Quebec carbon market, but the settlement price is significantly higher at $48.50 US, which is considerably higher than the 27 US dollars settlement price on the California-Quebec carbon market. And when we translate that into Canadian dollars, we get 66.85 per ton CO2, which is considerably higher, of course, than 37 Canadian dollars that we saw for the settlement price on the California-Quebec carbon market. And I think for me, from a Canadian perspective, this price of 66 is actually quite significant because the federal carbon backstop price is currently set at $65 Canadian. So essentially, you have settlement price in Washington, the state of Washington, which has a comparable price at what we're seeing on the federal Canadian backstop, which essentially applies to everywhere but Quebec, and perhaps Alberta may have some exemptions right now. BC it's about $50. It's $50 per ton right now in BC, but they'll be transitioning to $65 in April. So I don't know, Colin, what do you think of these prices?
So, I have to caveat it. I'm certainly aware of the Washington program. I have not had a chance to dig into any of the modeling and understand the fundamentals and where the models say the prices would be. With anything like this, obviously, it's the first auction. Use a very significant grain of salt when looking at these and give it a year to stabilize before we start. A lot of entities are probably jumping in the first auction to try to build up kind of a reserve as a hedge against in case the price keeps going up even more. And so, you get sort of a little bit of herd behavior, and we'll see what happens. Another possible explanation for the higher price is that Washington just doesn't have quite as robust policy portfolio as California. They also, their baseline is set many years in the future, and so already has kind of priced in the impacts of the Great Recession, 08 to 2012. as well as the lower cost of electricity. And in Washington, the wind and solar cost effects are going to be less because their electricity grid is hydroelectric dominated, very low emission from the start. And so that might also be why, right? There's not as many easy reductions to be obtained by decarbonizing the grid because it's already fairly low carbon. So, you know, I think you could certainly find an economic fundamental argument to say why it is will continue to be higher than California. You can also find an argument to say this is, you know, just sort of opening market exuberance and the prices will potentially converge. You know, definitely I would note that a $48 US carbon price is a whole lot closer to estimates of what the social cost of carbon actually is. So, you know, even if the price stays at this level, I would say that's a much more functional price, much more likely to deliver the kinds of issue outcome the state's looking for than California's price.
Mm-hmm. For fun, I'll just show also the proportion of allowances sold, and this is also just suggesting some initial exuberance. 100% of the allowances that were at auction were sold. We saw that was about 90% in California-Quebec. I don't know. Any thoughts here, Colin? Or yeah. So that's about all we had planned for today. Again, we're just doing these regularly after the quarterly auctions. The next auction will be in May, and we will have a webinar in French in early June.